The Precious Metals Week in Review, June 3rd, 2016. Brought to you by Precious Metals International. Markets eagerly awaited the release of the May Non-Farm Payrolls NFP report on Friday, as media pundits continue to parse and overanalyze every word uttered by anyone remotely connected to the U.S. Federal Reserve. When the report was finally released, the data was a massive disappointment. The number of Americans filing initial claims for state unemployment benefits dropped 1,000 claims last week, falling to a new seasonally adjusted level of 267,000 for the week ending May 28th. The previous week's data was unrevised, and this marks the 65th straight week that jobless claims have been below the key level of 300,000 claims that most economists view as a steadily improving labor market. Friday's U.S. non-farm payrolls report completely missed expectations. Economists had expected the U.S. economy to add roughly 162,000 jobs in May, and Friday's report showed the addition of just 38,000 jobs. The unemployment rate was lowered to 4.7%, but that appears to be due to another drop in the labor force participation rate, which fell to 62.6%, back to near 40-year lows. The official unemployment rate does not count those who were not actively seeking jobs during the reporting period, or those who were underemployed in only part-time positions, so a dropping participation rate would immediately be reflected as a lower unemployment rate. China's much-discussed service economy, which many analysts feel is the key to China's renewed economic growth, slowed in May, according to a private survey of the sector. Caixin's Purchasing Managers Index (PMI) for the services sector dropped in May for the second straight month, falling to 51.2 from April's reading of 51.8. A reading above 50 still indicates expansion, but the second monthly decline in a row has economists worried that the downward trend could continue, placing yet another drag on China's slowing economy. Japanese Prime Minister Shinzo Abe announced on Wednesday that Japan would delay a planned sales tax hike by another 2.5 years. The move was widely expected, particularly after comments that Mr. Abe made last week, in which he said he was concerned about a 2008-style crisis could be on the horizon, but the repercussions of the delay could be substantial. The move to delay the sales tax may boost consumer purchases in Japan, which took a huge hit after the previous sales tax hike in April of 2013. But Japan's growing debt load, which exceeds 200% of Japan's gross domestic product, would likely have been trimmed down by the proceeds from that sales tax hike. This may mean that the benefits that the Japanese consumer sees from the delay in raising the tax may be offset by a further increase in debt. In Europe, the date for the referendum on whether the United Kingdom will remain in the European Union is fast approaching. Most of the polls which have been trying to predict the outcome of the vote have been described as wildly inaccurate, and many UK watchers feel that the margin between the stay and leave camps is much closer than any of the polls are predicting. Given the abysmal NFP report out of the US this week, it is even more likely that the U.S. Federal Reserve will wait for the results of the June 23rd referendum before deciding to make another move on interest rates in the U.S., which means July will likely be their next opportunity to conduct another interest rate hike. Crude oil prices continue to hover around $50 a barrel for Brent crude on Friday, despite an OPEC meeting this week, which failed to see the cartel reach agreement on freezing oil output targets. Iran continued to insist on raising its production to regain the market share it lost through years of sanctions over its nuclear ambitions. But Saudi Arabia's energy minister told reporters that they will be very gentle in our approach and make sure we don't shock the market in any way. Oil analysts took that statement to mean that Saudi Arabia would not flood the market with oil to try to maintain its own market share in response to Iran. Continued supply disruptions are also supporting higher oil prices for the moment, as global oil production levels decline in their wake. The euro began the week with a brief dip lower against the US dollar and then began climbing higher in peaks and valleys until late Thursday, when the euro suddenly plunged. Thursday's plunge in the euro was halted before it could turn negative for the week against the US dollar, and it began moving sideways into Friday trading. Friday's abysmal NFP report sent the euro surging higher, and it appears set to close the week higher against the dollar. The Japanese yen also began the week dropping lower against the dollar, but had found a floor by Tuesday and began moving higher from there. The yen crossed into positive territory against the dollar by Wednesday and continued climbing through Friday, and a sudden surge following the release of the NFP report appears set to see the yen close the week higher against the dollar. Friday's NFP report sent media pundits scrambling for reasons to explain away the horrible performance, and they began flooding the airwaves with their projections that a June rate hike by the U.S. Federal Reserve was now off the table. Just yesterday, these same pundits were saying the Fed would likely hike rates in June even if the data in May's NFP report was weaker than projected, but no one expected the report to be as bad as it was. Precious metals surged higher immediately following the release of the report as the Federal Reserve's credibility grew weaker and the likelihood of its ability to conduct another rate hike in the near future seemed to dwindle further and further away. The media are now seemingly hyper-focused on the so-called Brexit vote on June 23rd, essentially writing off the U.S. Federal Reserve's June meeting, which will take place prior to the UK referendum. Polling in the UK shows a sharply divided country that cannot be guaranteed to vote to stay in the EU, and the uncertainty surrounding the aftermath of a vote to leave is creating increased volatility in markets across Europe. As the rhetoric increases in Europe ahead of the referendum, European market volatility should be expected to continue. In Asia, China's economy continues to struggle to maintain growth, and recent moves by Beijing to devalue the yuan further have analysts concerned that Chinese officials and regulators could mishandle their stimulus measures and create the economic hard landing they are trying so desperately to avoid. In Japan, Prime Minister Shinzo Abe's announcement that a planned sales tax rise would now be delayed by an additional 2 years was met with mixed reviews. Some analysts feel that the delay in hiking the tax rate might trigger spending by Japanese consumers, which would in turn trigger renewed growth in the Japanese economy. Other analysts point out that the massive debt levels in Japan, which exceed 200% of GDP, could grow even higher since the proceeds of the sales tax hike would ostensibly have been used to pay some of that debt down. Oil prices have maintained levels near $50 a barrel amid supply disruptions in Nigeria and Canada, and comments that Saudi Arabia made this week suggesting that they might finally tolerate higher prices. Iran also made comments this week, however, saying they would ramp up their own oil output to attempt to regain the market share that they lost through years of sanctions. Given Iran's contentious relationship with Saudi Arabia over the years, nothing can likely be taken for granted in either of their oil production forecasts. On the heels of Friday's horrible NFP report and ahead of the Fed's June meeting and the UK's referendum on June 23rd, market volatility, particularly in Europe, could increase. Fed officials have been making comments over the last several weeks that have been strongly suggesting they would be conducting another interest rate hike at their June meeting, but the weak NFP report, combined with weak manufacturing data in the U.S., likely will not allow them to carry out that rate hike, further damaging their credibility among the rest of the world's central banks. In this environment of continued global uncertainty, wise investors continue to take advantage of temporary price dips in physical precious metals to acquire additional product as part of a well-diversified investment portfolio. These savvy investors recognize that an economic environment where debt which returns negative yields is rapidly growing is an economic environment that results in nothing short of the systematic destruction of cash. The much overused phrase that gold doesn't earn interest has been seemingly retired in an environment where depositors have to pay their banks to hold their cash. Remember that precious metals should always be viewed as a long-term investment, and that the key to profitability through the ownership of physical precious metals is to actually acquire and own the physical products, and to hold them for the long term. Always remember that you should never overextend your ability to maintain ownership of your precious metals over the long term. The Precious Metals Week in Review, June 3rd, 2016. Brought to you by Precious Metals International.